Over the past few years, investing has started to feel less like analyzing numbers and more like watching a game show. It's entertaining, sure, especially when someone turns a risky trade into a 2,000% gain and proudly shares a screenshot online. But beneath the excitement, there's a sense of unease. Historically, markets were messy, but they followed rules grounded in reality. Earnings, cash flows, and economic trends. Fundamentals, the boring adult stuff, mattered. Yes, markets have always gone through phases of hype, whether it was tech stocks in the early 2000s or real estate in 2008, but eventually reality caught up. Intrinsic value acted like gravity. You could ignore it temporarily, even make memes about it, but it always mattered in the end. Lately, though, that relationship feels different. Since 2020, market prices and fundamentals seem like strangers in the same room, aware of each other but not talking. The old advice to invest long term in solid companies has shifted to a simpler mantra: buy the dip because prices only go up. And while that's worked so far, it's no longer a strategy, it's an assumption. This change didn't happen by accident. A flood of new investors, historically low interest rates, and unprecedented money printing created a market mindset where every pullback is a gift. And it's not just retail investors affected. Professionals who built careers around fundamental analysis, like Michael Burry, have struggled. Burry, famous for betting against the housing market in 2008, recently closed his hedge fund, saying essentially, markets no longer price assets based on value. So if fundamentals aren't driving prices, what is? Enter behavioral finance. Unlike traditional finance, which assumes rational markets, behavioral finance studies the human side: greed, fear, herd mentality, and biases. For decades, it was niche, explaining odd market behavior here and there, but now it's front and center. Social media and instant news have amplified emotions, turning narratives into market-moving forces. A tweet, a forum post, or a viral headline can shift prices faster than earnings reports ever could. Institutions are adapting, factoring online sentiment into their models, because since 2020, human reactions often predict short-term price movements better than fundamentals. And that leaves us with a question: are we in a temporary bubble, or is this a permanent shift? Maybe one day gravity will return, or maybe attention and psychology are the new currencies in markets. Either way, the rules have changed, and every investor must decide if they play by the old playbook or the new one.